Our starting point tonight is right here in Kenya. Borrowers are not having the Christmas they might have expected. The central bank on Tuesday raised the benchmark lending rate by 200 basis points to 12.5%. Now, that is the highest rate since September 2012. Back then, the central bank policy rate was about 13%. The decision is likely to see bank retail rates for some customers hit several highs, perhaps as high as 28% in some cases. The Central Bank of Kenya says that it needs to raise rates to this level in order to deal with the exchange rate depreciation. It says a much weaker shilling is exerting upward pressure on domestic prices and the rise of the public sector external debt service costs. Now, according to the bank, inflation in the country dipped to 6.8% year-on-year in November from 6.9% in October. The currency, the Kenyan shilling, is down by more than 25% against the American dollar, having struck repeated all-time lows the lower it went.
The reason why we have increased significantly the CBR was to address the risks and the uncertainty that has been introduced in the economy because of the depreciation in the exchange rate. It seems nobody knows where the exchange rate is going to be next week or the week after. That depreciation has also interfered with our mandate of price stability and has been contributing to increase in inflation. So in our view, it was very critical that we address that depreciation to address the cost of living, to address the increase in debt service and the external debt, to bring back macroeconomic stability. And those are actually the things that will encourage foreign direct investments to come into the country.
All right, then. So 200 basis point hike, not exactly what the market expected, but will it actually meet its objectives? Let's explore the outcomes here. Charlie Robertson is the head of macro strategy at FIM Partners. He's also the author of The Time Traveling Economist and is joining us now live on the program from London. Charlie, good to see you as always. So let's start with the central bank's argument here, right? That 200 basis point hike, the idea is, they say, to rein in the Kenyan shilling, put a floor under that 25% move that we've seen so far this year. But earlier in the same presentation, the central bank governor himself said Kenya's competitiveness has eroded, FDI inflows have declined. So given those two factors, will this rate hike achieve the intended outcome?
Well, I think it was a powerful move. The first people who tend to react to this are the portfolio investors, not the foreign direct investors. Portfolio guys are like FIM Partners. We're paying attention to the markets. We're more likely to make that first move back into a country. And foreign direct investors then take their lead from whether or not portfolio guys are feeling confident. And it was a big move. I mean, we had the 100 basis points first move in his first meeting. He's doubled up with this one. And he's giving us an interest rate which does start to look interesting for the first time in, well, years, actually. You've got a potentially appealing interest rate that says, should we go and be looking at Kenyan shillings? But I think you'll be talking about market reaction to it in a second, so I'm not going to jump ahead of you on this one.
Right, but let's just dig a little deeper into that interest rate question, right? Because, sitting from this end of the desk, I'm looking at domestic debt. We had a tap sale, for example, on an infrastructure bond that had a coupon rate of 17.9%. Short-term paper is at 15 and some change. At those levels, was that not an attractive entry point? Or let me flip the question around. From a portfolio investor perspective, what qualifies as an attractive rate?
Well, before this, the 1 year rate, 1 year rate today is giving us about 16% yield. Inflation's running at about 7%. So I'm getting a 9% real return now owning shillings. And that is interesting. Foreign portfolio funds like FIM Partners do look at that nominal yield, and at 16% is interesting. But then they have to take into account how much are we going to lose on the currency. Now, I think the currency is about 5% cheap on our real effective exchange rate model. So that's telling us the downside risk is much less than it was 2 years ago when it was 20% overvalued. So 2 years ago, it was like you've got a good chance of losing 20-25% on the currency in real terms, on top of nominal depreciation. I'm not going to try and overcomplicate things here, but basically it was telling me it was a risky trade. Now it's become much more interesting. It's the second highest real yield. The difference of interest rates between inflation and 1 year rates is the second highest in Africa now, of the 25 countries we look at. So I think it helps. But today, dollar yields are still offering us 11% on the 2048 euro bond. So you can get a good yield in dollars that doesn't carry any currency risk at all. But I think the central bank has helped reduce that currency risk materially with this move.
Indeed. I want to get back to that currency question, because this has been a bit of an evolving debate. We're seeing the currency now at essentially 153.3882, I think was the number that I saw from the central bank. But given the fact that the currency was overvalued as much as it was, and the central bank governor kept arguing that, the currency depreciation, in his view, has been overdone. But are we there because essentially, A, it was overvalued and maybe it has overshot, or B, simply because, we're in a situation here where the currency essentially has not been properly priced. Price discovery has been a problem in the market because the local FX market was dysfunctional for the better part of the last 5 years.
Yeah, no, that's certainly true. Look, it was overvalued. Kenya was able to go out and borrow dollars. Everyone globally was able to go out and borrow dollars in the 2010s. And that then supported investment, the sort of investment that builds infrastructure, the FDI quite likes. That was all nice and easy. That easy story's gone. China's net lending, as you know, has been cut in 22 dramatically. The world markets are obviously much less willing to lend dollars. And so Kenya's had to adjust. And the current account is the best way to try and compensate for that. If you can't borrow dollars from abroad, if you can improve your current account position through weakening your currency, you're putting yourself in a stronger spot. I mean, it was one of the conclusions from the time-traveling economist, very kind of you to mention, was that trying to improve your current account by having weaker currencies could reduce interest rates in the medium to long term. Short term, obviously not, and we've just seen that hike now. But in the medium term, I think Kenya is going to be in a better position than it was. And so this currency adjustment helps. It hasn't really overshot that much. I mean, yes, I'm saying 4 to 5% cheap, but there's loads of currencies I could look at and have looked at in the past that got to 20%, 30% too cheap, implying, a Kenyan shilling closer to 200 to the dollar. That we've seen that sort of level in other countries. So I wouldn't say it's gone too far. In fact, I think in real terms, I'm not sure this is going to help the currency strengthen back from here. It's probably quite good for it to stay roughly where it is, because that helps on the current account, brings in a few more dollars to the economy, and helps provide some funds for investment.
Indeed, and as you pointed out, it's the level that the central bank, sort of needs to get comfortable with. I want to move on to the 2024 Eurobonds, though. Check the yields before you came into the program. 13.6% at 15.25 GMT, priced around 96 cents on the dollar. Does a move like this help to settle nerves among Eurobond holders, or is this in the context of, investors who are holding our 2024 note, is a move of this magnitude essentially irrelevant?
I don't think it's irrelevant. I think it helps. I think it's giving us a signal that the authorities are pretty confident about their ability to repay that bond, that they don't see the need for the current account to just for the currency to weaken even further, to crush import demand even further. I mean, higher interest rates will slow import demand, but it does it in a more market-friendly way, in my opinion, than FX shortages. What we've seen in places like Pakistan or Nigeria or even Egypt has been FX shortages as the way to try and improve the current account. It helps, but it's not done in a kind of market-friendly way. It's better to say this is
inefficient.
Exactly. It's leaving the central bank as the determinant for how valuable the currency exchange is, rather than you. You should be the one saying, I want to buy this currency and I'm prepared to pay that rate for it. It shouldn't be up to the central bank to decide, well, I'm going to give you the money, but not that guy over there. So I think this is helpful. We're moving in the right market direction, and it's a good step, I think, towards helping slow that shilling depreciation we've seen.
All right, I want to wrap up with the Eurobond as well, because one of the big narrative arcs for 2024 has been, the size of the buyback, right, that the government has kept on promising will happen. 6 months ago, the president said it was going to be $1 billion that will be bought back. In October, in a conversation with the central bank governor, he told me, well, actually, no, we've revised that number downwards. It's now $500 million. And then in November, the president turns around and says, actually, no, we've revised that down again to $300 million. Now, the constant changes in this target aside from the time being, with the prices that we mentioned earlier, 96 cents on the dollar, I mean, from where I stand, it doesn't look like there's any merit to a buyback at the moment. What do you think?
I mean, it helps reduce the risk, the perception of risk a little, because the less that has to be repaid in one big go in the middle of next year, when it's 2 billion, it's sitting there as this, are they really going to pay all of that back and hit their reserves in the way they do? I assume they do, but if they've cut it by 300 million, that slightly reduces the risk. I think the rating agencies, I think generally do rate countries fairly. By the way, on this, I've been a bit unfair. I don't see that buybacks are in any way a negative for a country's creditworthiness. But I think they've been saying to Kenya and others, be careful. We might downgrade you if you do buybacks. And I wonder if that's played a role in the reducing the amount that they're considering in terms of this buyback.
But if you're a bond holder and you're looking at Kenya's reserves in the course of the year, right, it's essentially just been a downward sloping curve, right, for the bulk of the year. And you're listening to policymakers saying, we'll do the buyback, we'll do the buyback, we'll do the buyback. But then you ask yourself, with what money? We're not seeing it coming through, right, into the reserves account, because ideally that's where it would essentially show up first. There's a credibility problem here that's being built up by saying, we'll do the buyback, but you don't have the money to pull it off, and you keep changing the targets 24/7.
So I think originally the idea of $1 billion was because you could use reserves, because why not? One way or another, you're going to be using the dollars available in the economy. But the rating agencies are saying, well, if you use reserves, we'll take that as a negative. So I think that then told them that they had to go out and raise new finance to cover any early buyback. And I suspect that they're finding that's not that easy. And the potential lenders are probably saying, why are you bothering? What's the point of doing this early? If you wait long enough, maybe the Fed funds are down low enough, maybe frontier markets start to get access again to financial markets. So there's no great advantage in doing it now. I would think that's one of the factors that's played a role in this shrinkage of the buyback plans.